We are live. Well, not live, but recording.
Live. Hello, Internet.
All right, Matt McKay here with Expert Mortgage Group. I've got Corey Bowes and Steve Himmelman. We're going to have a chat about commercial financing. So Steve is joining us and from Bookco. They do virtual accounting and also a commercial real estate agent. And we've got our very own Corey, which is a commercial mortgage associate with us at Expert Mortgage Group. So welcome, gentlemen.
Good morning.
Thank you. Good morning.
Excellent. So we'll start off. I mean, it's been an interesting time at Atlantic Canada. We've seen some different products such as the CMHC MLI Select over the last few years, and just we really want to kind of dive in on accounting versus lending and how that how all of those differentiate themselves when we're looking at these different types of financing or accounting practices. So we'll jump right in, and Corey, I'll hit you up first on the discussion on CMHC MLI Select. So on the CMHC MLI Select, could you describe essentially what is the CMHC MLI Select and who qualifies? Like, what's the best use for it?
Absolutely. In a nutshell, MLI Select is multi-unit financing for 5-unit residential rental properties. It covers anywhere from construction to refinances to purchases. And MLI Select is a point system that CMHC created, and you can earn points based on the affordability or how many affordable units you have, on energy efficiency of the building, and also having accessible units. So in the scoring, if you score anywhere between 50 to 100 points, there are different tiers where you can qualify for amortizations between 40 and 50 years. Also, debt servicing on all tiers can be as low as 1.1. And in terms of pricing, you certainly have the advantage of premium pricing from lenders because CMHC is providing that insurance.
So on that, like, what's the loan to value? Like, how high can you go in terms of financing with the CMHC MLI Select?
It can be anywhere from a maximum of 85% if you are able to get 50 points for refinance or a purchase, up to 95% for a construction, or if you have 70 or 100 points, you can qualify for 95% financing.
And that's a really appealing product, and we've seen investors, really capitalize and using it as a tool essentially to bring new units to the marketplace. And it was introduced, I guess, to bring more units, right? And when we saw the vacancies essentially just at records low. So with scoring pillars, like, what are the most realistic ones for Atlantic Canada when we're looking at the financing qualification of it?
Mm-hmm. It can depend on the type of financing. So if you're looking at new construction, certainly energy efficiency is one where you should be able to achieve some of the points. Affordability is where we see most projects gaining their MLI Select points. For existing properties, you have to have a minimum of 40% of your units being affordable. So depending on where the rents are, it may already qualify for anywhere from 50 to 100 points on affordability. There are options for energy efficiency where you can make upgrades to existing properties to get energy efficiency points. But if you're looking to get the maximum 100 points to maximize your loan to value and your amortization, then you will need to have some affordability component to get to the full 100.
So on that, what would be the common pitfalls, I guess, or what makes for a strong application? And or I guess it sounds too good to be true. Like, what's the typical borrower like, essentially? What do they need to qualify?
To qualify, you would need to have a personal net worth of at least 25% of the loan amount that you're seeking. CMHC is also going to look at the borrower experience in terms of property ownership. If it's a construction project, looking to see, have you built a rental property before, or they'll look at the experience of your builder. They're also looking, and to go back to property management, they're generally looking to see that you have at least 5 years of property management experience if you're planning to manage the property yourself, or you could hire an external property manager. Certainly, some of the pitfalls and challenges we see are if someone designs a building and they're ready to go to the financing stage, but they haven't really looked at the pro forma income expenses to see how much they may qualify for, or if they're trying to qualify for affordable units. It's really beneficial to come to us as early as possible in the process, even when you're looking at, before your design, to look at the numbers as far as, if you're building 30 units, you want to have at least 10% affordable. So you may consider building those units slightly smaller, so that your cost is lower, so that your return on those affordable units is comparable or not extremely lower than the other units.
Super. Yeah, absolutely makes sense that you want to maximize your project and kind of dive into the early stages of conceptuals and before drawings. So one thing that is clients come to us is they're always, debating, do I buy it personally or do I do it in a company? And we always provide our advice as far as mortgage brokers and associates, essentially in the lending perspective. But curious to understand, Steve, what that looks like when it comes to the different tax considerations, and how that differs from one to the other.
Yeah, no, and from an accountant point of view, it's more kind of what is a client's goal, their strategy going into it. Kind of dictates kind of the advice you give. A lot of people, to be honest, they go whatever the easiest route. They want to just get into a rental property, so it's easier to get a personal mortgage for the rental property, maybe the first house, and they move into a second house. That's kind of rentals, or they buy a duplex. So a lot of times it's driven by how they can get the mortgage, how they can get the money to start it. The first property being within held personally is actually not a bad idea for a couple reasons. Speaking here, particularly in Halifax, Nova Scotia, is property tax. It's not a CRA tax, it's municipal tax. If you buy a property here in Halifax and you own it personally, you're capped. So your property tax, your assessment rate is capped at 3%. It's not going to increase uncontrollably. So you can actually control your property tax expense. That's one of the biggest things, is kind of it's controlling your expense in any rental property. Your revenue is fixed, so you got to control your expense as much as you can. As far as tax implications, it depends on the person, their finances. Some properties, we all know, let's be honest, rental properties, they don't really generate a lot of income. You hope to generate some cash flow out of it. You hope for it to pay for itself. At the end of the day, when you sell it, you get the appreciated value. That's what you're going for. So it's important to minimize your tax through the whole process. For individuals who owns a property personally, it allows them to balance out their employment income if they're self-employed, and then the rental income. The rental income, using depreciation, we can always kind of bring down to zero. We can't create a loss with the rental income, but sometimes these rental properties, especially if it's the first one, you got to put a lot of money in to get it up to par. A lot of repair and maintenance. They actually may lose money on a new mortgage with the interest rates. So we can actually use that against their employment income as well too, so it can lower their personal tax rates. But the primary strategy really for a lot of people start off, they just won't get the first building. It's only when they start looking at actually growing a portfolio that it can get a little bit more confusing. And this is really where then we go to like Corey, for example, who would explain to the client the best way to grow your portfolio in the future. If you own a building in a corporation, the tax rate is higher. If you can't defer or pass expenses between employment and business expenses, it gets stayed in that corporation, generally speaking. And you are subject to more government whims as well too. Like what happened 2 years ago when they wanted to raise the capital gains. They were more aggressive against the corporations than they were for individuals. That didn't occur, but you have a bigger voting block in a corporation. You have a bigger, all the individuals are strong, more of a voting block. So the government's always going to favor what's best for the individual, and the corporations usually pay a higher price on any change in government policies as well. Even when you look at, securing mortgages and the mortgage rates, typically a commercial mortgage would be more expensive than a residential mortgage as well.
So on that, so I guess what I'm gathering is like would have to be, it's based on the strategy and what the planning is, right? So if they want to build a portfolio, they should have a chat essentially with you guys essentially and with your accountant to look at the long-term planning and how many units that they plan to own and what that's going to look like essentially in their and probably how long they want to either buy and hold or sell earlier, right?
Oh, exactly. And ideally, they bring us to the table before they make
Right.
the purchase to talk about it, so we can have a better understanding and advise before they make the acquisition, um, because it does have long-term implications. It's expensive to move a building, personally into a company, can trigger some taxes, um, and we just want to make sure things are set up right in the first place.
Absolutely. Super. Excellent. No, it's great advice. So on that, when it comes to financing, Corey, what is how does that looked at differently when you're looking at the financing of properties on the personal side versus the corporation? And if you're, and maybe comment too on if you're looking at buying stuff with partners and what that looks like and the complexity if it is bought personally versus corporation in that scenario.
Yeah, and to Steve's point, it's good to have those conversations early and find out what their goals are. That's certainly key. From the lending standpoint, it can be a degree easier to if everything's separated, kind of in silos. So if the property is in a company and separate from your personal finances, for lenders, it makes it easier because they can look at your income and expenses as an individual, and that's your personal debt servicing, and they can look at the company separately. That being said, we've done financing in personal names and company names. So part of it depends on, I guess, how many units you may plan to own eventually in your personal name, because lenders will have limitations as well. So maybe a certain number of units or a certain number of properties in your personal name that they'll look at. So yeah, it goes back to having those conversations early and looking at your longer term strategy and planning to see what makes the most sense.
And I suspect, Steve, like it also depends on how they're already set up. If they have an operating company or they have a holding company or whichever, like how those are set up and the long-term planning of it, whatever it's or what and how long did they have essentially before they look at selling them, right?
Oh, exactly. Like that's again why the early conversations are so important. You need to know their intentions. Like, are they going to buy and hold it and let it appreciate? Is it a short-term situation, or do they want to go in, you know, buy it, fix it up, and refinance it? It all has implications at the end of the day on how best, essentially, to get the money out as tax beneficial as possible. The other thing too is a good point that Corey raised too, is like it depends on the building they're buying. You like, and Corey, like how many units can you have before you have to go to a commercial uh, financing?
Well, five. Oh, go
Oh,
ahead.
sorry. No, you can go ahead.
Yeah, so anything that would be 5+, I guess, is where we kind of categorize as commercial. So 5+ units per like in a building, for example. But as soon as we see lenders, even on the residential space, if some lenders have a 5 limit, some of them have a 10 limits of properties, right? So if they go beyond that, then it becomes complex when it comes to the financing of it because they're looking at the personal. So it could be good and bad when we're looking at the personal because it also we're only using a percentage of the rental income to qualify. So it could deteriorate your personal debt ratios and make it more complex if they're looking at building or buying a personal home too. But anything that you want to add, I guess, Corey, on that note?
Sure, yeah. And going back to my former career as a lender, commercial lender, depending on which lender you're with, like you said, the policies can be different. You may be able to separate it within your application that you're submitting for approval, the personal finances from the properties themselves, the income and expenses, even if it's all in the personal name. However, some lenders do require that all of those properties be looked at under the personal debt servicing figures. So yeah, lender to lender can be quite different.
How about if you go in for the MLS financing? Generally, you're buying a unit, for four or more units to qualify for MLS. Um, and then a typical investor, again, it's all about cash flow. So they're striving to get, the 40, 50-year amortization. So the building cash flow is positive. Um, at that point, when you go for MLS financing, do you have to be incorporated or can you own it personally?
No, for CMHC financing, you can be incorporated or you can own the property personally. We have done both. Really, the CMHC and the lender, the primary numbers they're looking at are the income expenses of the property itself, to determine the net operating income and how much of a mortgage that property can handle. So as long as as long as we can show like I said, it can depend on the lender. So there may be some lenders where that wouldn't work if it's in a personal name. But for the ones that it will, where they can more or less separate the personal income and debts from the income property itself, then certainly that can potentially work.
And that's a great segue to my next question is the use of private lenders. So we've done private lending transactions, but just kind of looking at diving into that question for Corey is in what situations does private lending make sense, and maybe explain on how lenders are looking at financing on when we are looking at multi-units, for an example, and sometimes why they don't work, like if the rents haven't been kept up to where they should be and so on, right?
Yeah, absolutely. When a lender's looking at the income property, like mentioned, they're looking at the net operating income to see how much of a mortgage the property itself can support. So, like you said, the rents may not have been updated for a few years. Sometimes, owners of properties, they may have owned the property for a long time. They don't have a mortgage or they have a small mortgage. So they haven't, their cash flow has been solid and they haven't really had a need to make sure that their rents are kept at market. So in those situations, the purchaser needs time to be able to make any building improvements they need to make, or increase the rents. And of course, that's subject to rent cap limitations as well in some provinces. So in those cases, private lending can make a lot of sense to give you that time to be able to improve the operating income of the property, and then to be able to qualify to have it paid out with conventional financing.
So what would make a good private lending project, I guess, in that case, when you're looking at optimizing a building, so a short-term type financing?
Absolutely. Private lending is really meant to be, 6 months to maybe 24 months maximum. So as long as you're able to make those changes within that time period, and the private lender can see that timeline is realistic, then it may be a fit. Because the private lenders want to make sure that there's an end and strategy basically, and an exit strategy, so that you can, because it is more expensive, and of course you don't want to be in that financing longer than you have to. Otherwise, that's going to eat into your profits and your equity.
And I remember of a good little scenario or story, I guess, of clients that you were able to help on exactly that note is like private lenders so lenders will use the lowest of purchase price or appraisal value, for example, typically, right? So I think you had a good story where we had two individuals looking at buying from their father, essentially looking at selling that asset. Maybe if you want to talk about that case study briefly.
Absolutely, yes, yes. So looking at, like you said, looking at purchase price, I believe in that case it was $600,000 purchasing from the father, but the appraised value was over $900,000. So on the private lending side, they were able to look at the appraised value to be able to provide financing and provide the full $600,000 to make that purchase. And then the new owners, the sons, were able to provide the updated leases and updated expenses, and within a year we were able to move that to a conventional lender. So really, they were able to acquire the property from the father without any equity injection, any cash into it, and the father was able to pass it to his sons at a lower cost as well, saving on income taxes.
Super.
I think the other key too is coming out from like the commercial real estate agent side is private lending can really make it happen quick. Where traditional financing may take a longer underwriting process. So do you find a lot of people they see a great deal and then they just want to get private lending, secure it for 6 months while they can work on the application for traditional loans?
Absolutely. I think that's a great point, Steve, is it's doing a private lending deal and being able to buy the property versus missing out on waiting on traditional lenders to get to the finish line is a great strategy. But yeah, we've seen some clients do build portfolios very successfully using that strategy. But yeah, Corey, any further comments, I guess, on that?
Yes, certainly, and it can be a great fit for construction as well. And part of that is the speed. And there are builders who are not necessarily new builders, but they use private financing for all their construction, and then they're either listing the property for sale or they're refinancing it if it's a rental property. Because of that speed, because in some cases you may not it may not take 2 or 3 weeks to get a draw from the financial, where it may take 2 or 3 weeks to get a draw from the financial institution. The private lender may be able to do it within a few days. They may not need a full appraisal update or a progress report from the appraiser. It may just be some pictures, could be a site visit, and they may be all set. So that they can pay their sub trades and keep the project moving as quickly as possible.
Yeah, and that leads me to an example of a client we were able to help, well, probably 10 years ago now, but he was buying a property that had an environmental issue, and traditional lenders would not have lent on that property. But since he was able to purchase it, we financed it with private lender, did an environmental cleanup, and now the property 4x within that last 10 years, essentially, of him being able to buy it, clean up the site, and now have a good operating building to be able to leverage on other future projects. So yeah, it's a fit or a solution, I guess, for lenders, for investors. But on that note, Corey, what should investors be prepared to when they are looking at private lending? Like, what does that look like? For cost is obviously more expensive, but what should they be prepared for, I guess, either paperwork or psychologically?
Certainly the cost is one factor. That there are higher fees upfront, and the interest rate will be higher. However, if it's a short-term project, really you need to build that into the cost of your project, whether it's construction or whether it's a purchase and refinance, along with your other closing costs, and really look at, does it make sense? What is the opportunity cost if I use private financing to make this deal happen, or if I don't because I can't finance it conventionally right now? Is really look at it that way. What is the value in having this project go forward?
Great comment, and love the ability of just looking at the opportunities. Like, if I don't do it, what is it going to cost me, right? So I'm just adding that as a kind of a sub-trade line. But you mentioned on construction, kind of leading into my next question. So we've seen some changes on HST on multi-unit constructions over the last few years. So I think there's an opportunity for investors to capitalize on that. So Steve, could you maybe elaborate on what that looks like for example, how it's recovered, some of the common mistakes of what people do, and so on?
Yeah, again, and this is all this is one of the good government policies that I'm actually in favor of. I was talking about for years, glad it finally happened. The whole thing is trying to make apartments or residential affordable again. Now, we all know construction costs went through the roof. Um, and HST is a huge part of that construction cost. So typically, just to recap on how HST works in most situations, is that for a builder, for example, when they go to buy the supplies, they pay for the lumber, plus they pay for the HST. And then and then they can apply to get that HST back that they put in, because it's a cost of an input. HST is a value added tax. So the building's going to be of greater value. Now, in the past, what they had to do is at the end, they had to self-declare the value of the building, and they had to pay HST in that value. So what would happen is that and I'm making up these numbers just for simplicity. Let's say you build a building, it costs you $600,000. And then once it's done and complete, the assessed value is $800,000. You'd have to pay the HST on that $800,000 back. And that's a lot of cash. So then that would go into higher rents or higher condo cost, or just higher costs in general. So what the new changes in the HST policy, again, it's federal and also provincial. So Nova Scotia and Brunswick follow the federal lead to basically make it exempt on specially built residential buildings that you don't have to pay the self-assessed fees. So it allows the builder still to get the ITCs on the building, and then at the end of the day, they have to self-assess, but they don't have to pay in that higher markup. And so that should then again lead to lower residential housing costs is the plan for it. Now, in saying that, just like we said every other thing, it's always important to talk to your advisors or your team ahead of time, your commercial mortgage broker, your accountants. Myself, I bring in an HST specialist because this is a very high value asset, and you know they're going and you're prone to get CRA audits on it. So just because you want to make sure everything's done right at the very beginning, because it can be expensive to go back and correct. Some key things to keep in mind that to be eligible for this, it all depends on when the building started, like when were the footings, the foundation put in. If it was like before November 2024, it doesn't apply. You still have to follow the previous rules. If it's been after that in Nova Scotia, then you are eligible for the HST reduction on it. But again, you have to make sure you have the steps in place first. You got to make sure you have an HST number before you start, kind of first of all. And then you got to document the whole process and make sure your accounting's really up to scratch. Because when you start this, you got to think of, I know I'm going to be audited at the end of the day. Yeah, and that's where we bring in the HST specialists. Yeah.
And that's a great point, because it's, we've seen people sometimes do it the way that they think they should be doing it, and then boom, it backfires, and they're leaving like a lot of money on the table because it wasn't done right. So I think bringing in your team of professionals early in the game when we're looking at these projects is key to getting successful projects done.
Yeah, and a lot of people are not aware of the self-assessing rule. So like everyone's familiar with, like, I sell something, I charge HST in a sales invoice. I buy something, I paid HST on that invoice. But if you're building for yourself, you're not selling at the end of the day. Like, you're building it and you want to get people in to rent it. So that's another trigger point too. A lot of people aren't aware of that self-assessment, and at what point of time do you self-assess? So is it when the building is 90% complete, they have the first residential occupancy in there. There's rules that really have to be followed, and again, that's why really stress just getting a specialist in there just to make sure it's done right, revise from the beginning.
Super, great points. So on that, Steve, like, what area do you cover, and how do clients get a hold of you? What's your niche market? What kind of clients do you like working with? And what's the best way to get in touch with you, whether it's for commercial real estate, as far as advising them on that front, or your accounting practice?
Yeah, nope. You can get in touch with me both ways. Really, Bookco Virtual Accounting. You can always connect through me through that website, or LinkedIn directly. Are the best ways to get a hold of me. I'll give you my contact details. You can put down below.
Perfect.
And then my area of specialties is, again, on the real estate side, it's investors buying the multi-residential properties, or owner-occupied buildings, business owners who want to buy their own buildings, and then businesses who want to have, like, long-term leases, commercial space. So anything kind of business related, that's kind of where I feel I can add some value, because I can bring, like you guys mentioned before, those pro formas are ever important that you need to present to mortgage brokers. You got to tell the story of, I'm going to buy this building and this is how it's going to help me out. And it's got to be realistic.
Super, excellent. Appreciate the time, guys. Appreciate taking the time and giving all this information. So we'll link the information on how to contact everybody in our description. Wishing you the great day and reconnecting soon. Thanks so much.
Thank you.
Great, thank you.